To the casual observer, the silver price chart looks deceptively calm, a landscape of horizontal consolidation. But beneath that boring surface, the market at TM's internal plumbing is screaming. While the digital ticker moves in pennies, the physical vaults are experiencing a quiet exodus. As of late 2024, COMEX, registered. Inventories, ARMs, the silver specifically earmarked for exchange delivery, have hovered at levels that many analysts suggest are precariously thin when measured against the mountain of paper contracts layered on top of them. This isn't a standard price rally, it is the emergence of a systemic fracture. We have seen price spikes before, like the momentum-driven peak of 2011 or the liquidity shock of 2020, but the current signals are structurally different. We are beginning to see silver lease rates, the cost to borrow physical metal, behave in ways that historical data suggests precede a decoupling of paper promises from physical reality. When the cost to borrow the metal begins to defy the logic of the arbitrage trade, it suggests the physical market is no longer responding to the digital price. Industry reports indicate that the massive shift toward TOPCon solar technology is creating an industrial demand vacuum that the current exchange architecture was never designed to fill. We are moving past the era of simple speculation and into a period of mechanical failure. This is the story of the invisible fracture, the moment where the plumbing of global finance finally snaps under the weight of a physical reality that no longer fits on a screen. To understand the precarious nature of the current market, we must look back at April 2011. During that period, silver made a historic run that still haunts the memories of veteran traders, a parabolic climb that saw the metal touch the 50 mark. But that 2011 rally was largely a speculative fever dream, driven by retail momentum and a surge in investment demand that eventually broke under the weight of exchange-mandated margin hikes. It was a price event, but the underlying plumbing remained largely intact. Fast forward to the current market environment of late 2024, and the architecture of the move is fundamentally different. We are no longer looking at a simple speculative spike. We are witnessing a structural breakdown in the lending markets. So to recognize this, professional risk managers look past the ticker price and focus on silver lease rates. The cost to borrow physical metal. Historically, these rates hover near zero, reflecting a comfortable surplus of available bullion. However, looking at the trailing data from the last 18 months, we have observed recurring aggressive spikes in short-term lease rates. When it becomes significantly more expensive to borrow silver than it is to buy it on the futures curve, the market is signaling a physical tightness that was largely absent during the 2011 peak. This mechanical stress is reinforced by the shifting state of the COMEX warehouses. As of late 2024, registered inventories are the specific bars of silver earmarked for delivery against futures contracts have hovered at levels that many analysts suggest are precariously thin. While eligible stocks, our metal held in vaults but not offered for sale, or remain higher, the registered category represents the actual liquidity of the exchange. In 2011, the vault's plumbing was full. Today, industry reports indicate that the inventory to open interest ratio is stretched to a degree that suggests a single major delivery demand could trigger a localized liquidity crisis. Furthermore, the paper to silver multiplier has reached a historical divergence. For every physical ounce sitting in an exchange vault, there are hundreds of ounces of notional paper claims circulating in the digital markets. While this leverage system functions during periods of surplus, it becomes a liability during periods of industrial inelasticity. Unlike 2011, where silver was largely a play on currency debasement, the 2024 market is being squeezed by the TOPCon solar revolution. These next-generation solar cells require significantly more silver loading than previous technologies, creating a massive industrial vacuum. According to the World Silver Survey 2024 projections, we are entering the fourth consecutive year of a structural silver deficit. In 2011, the market could be fixed by raising margins and shaking out speculators. Today, analysts argue that higher margins cannot produce more silver for a solar factory that has already committed its capital to production. We are moving beyond the era of price volatility and into an era of mechanical failure. At the time of this recording, the gap between the digital price and the physical lease rate suggests that the plumbing of global finance is no longer able to mask the reality of a shrinking physical supply. This is the architecture of a squeeze that is not just about price or TMs, about the survival of the delivery mechanism itself. To understand the true fragility of the silver market, one must look past the price ticker and into the dark, complex machinery of rehypothecation. In the world of high finance, rehypothecation is the practice where banks and brokers use the assets posted as collateral by their clients for their own purposes. In the silver market, this has evolved into what analysts often call the paper multiplier, a system where a single physical ounce of silver can effectively back dozens or even hundreds of different financial claims. Imagine a single 1,000-ounce bar of silver sitting in a London vault. In a transparent one-to-one market, that bar belongs to one owner. But in the current ecosystem, that same bar might be leased out to a manufacturer, used as collateral for a complex derivative trade, and simultaneously cited as the backing for an exchange-traded product. On paper, 3 or 4 different entities believe they have a claim to that silver. As of late 2024, industry reports indicate that the ratio of paper silver traded on global exchanges to the actual physical silver available for delivery has reached levels that many market observers characterize as unsustainable. This is the essence of the paper multiplier. According to data derived from the leading bullion exchanges, the total notional open interest, nights, the sum of all active contracts around, frequently represents a volume of silver that dwarfs the total global annual mining production several times over. While this system provides the market with liquidity and allows for sophisticated hedging, it creates a geometric risk. The system functions perfectly as long as everyone is content to settle their contracts in cash. However, the moment a significant percentage of those paper owners demand the physical metal, the multiplier reverses with violent force. This creates what risk managers call a nonlinear failure point. If the ratio of paper claims to physical ounces is 100 to 1, the system doesn't just face a problem if 100% of people want their metal, it faces a systemic crisis if even 2% of them do. This is the rehypothecation nightmare, the realization that the vaulted silver market is operating on a fractional reserve basis, much like a traditional bank, but with one critical difference. The central bank cannot print more silver to stop a run on the vaults. Historical data from previous liquidity crunches suggests that when this multiplier begins to contract, it doesn't do so gradually, it snaps. We are currently observing signals that suggest this contraction is beginning. As of the final quarters of 2024, the registered silver stocks on the COMEX, the metal specifically designated for delivery, have remained near multi-year lows. When we layer the total open interest on top of these dwindling physical stocks, the coverage ratio looks increasingly precarious. Analysts suggest that we are witnessing a claims-to-metal divergence that hasn't been seen in decades. Furthermore, the mechanics of collateral reuse mean that much of the silver listed in eligible categories, or metal that is in the vault but not currently for sale, may already be encumbered by other financial obligations. If a major institutional holder has pledged their silver as collateral for a loan, that silver is in the vault, but it is not available. This creates a phantom liquidity that masks the true depth of the shortage. During the liquidity crisis of 2020, we saw a brief glimpse of this reality when the spread between the paper price in New York and the physical price in London blew out to unprecedented levels. It was a mechanical warning shot. In the current environment, this risk is exacerbated by industrial inelasticity. Unlike a retail investor who might be persuaded to take a cash settlement if the price is right, a TOPCon solar cell manufacturer cannot build a solar panel out of a cash settlement. They need the atoms. As industrial demand continues to vacuum up physical supply, the pool of unencumbered silver available to back the mountain of paper contracts is shrinking. As of late 2024, the gap between the digital promises and the physical reality has never been wider. We aren't just looking at a potential price increase, we're looking at a potential collateral event where the paper multiplier collapses, and the market is forced to reconcile how many people can truly own the same ounce of silver. When the music stops and the rehypothecation chain breaks, the market will likely discover that in a world of infinite digital paper, physical silver is the only collateral that doesn't simultaneously belong to someone else. To understand the hidden pressure building within the silver market, we have to look at the lease rate. Das, the interest rate market participants pay to borrow physical metal. In a healthy market, these rates are negligible, often hovering near zero. Why would anyone pay a premium to borrow a bar of silver when they could simply buy a futures contract? In a period of surplus, you wouldn't. But as of late 2024, the plumbing of the silver market is signaling a profound disturbance. Looking at the trailing data from the final quarters of 2024, we have observed a persistent and aggressive spike in short-term silver lease rates, specifically in the 1-month and 6-month windows. Industry reports indicate that these rates have periodically surged well above the historical normal baseline, occasionally hitting levels that suggest a localized panic among market makers. When lease rates climb, it tells us that institutional players the bullion banks and major industrial users are so desperate for physical bars right now that they are willing to pay a high premium just to hold the metal for a few weeks. This isn't speculative retail fervor. It is a scramble for physical inventory among the smart money. Analysts suggest this is a clear sign of backwardation in the physical lending market. Normally, silver tomorrow is worth more than silver today because of storage and insurance costs. When lease rates spike, that logic flips. The market begins to value metal in hand over metal on paper. Historical data from the 2020 liquidity crisis shows that these spikes often precede violent price adjustments, but the current environment carries an even more ominous weight. In 2020, the disruption was a temporary logistics failure caused by global lockdowns. Today, the stress appears structural, driven by a widening gap between annual mining output and surging industrial consumption. One primary driver identified by market observers is the industrial vacuum created by the global solar sector. As reported in the Q3 2024 industrial demand forecasts, the shift to TOPCon solar cell technology has fundamentally altered silver's consumption profile. TOPCon cells require significantly more silver loading than the previous generation of PERC cells. For a solar manufacturer, silver isn't a financial asset. TMs, a non-negotiable raw material. They cannot settle their production needs in cash. This industrial inelasticity means that when the physical supply tightens, these manufacturers must compete with bullion banks to secure whatever registered stock remains in the COMEX or LBMA vaults. This competition is what drives lease rates into the red zone. When we see the cost to borrow silver spiking alongside dwindling warehouse inventories, we are witnessing the secret language of scarcity. It is the sound of the mechanical gears of global finance grinding. While the retail public watches the spot price on their phones, the institutions are watching the lease rates, recognizing that the buffer of unencumbered silver, metal that isn't already pledged or promised to someone else, is evaporating. At the time of this recording, the gap between the digital price and the cost of physical borrowing suggests that the market is no longer pricing in a surplus. It is pricing in a structural failure of the delivery mechanism. If lease rates continue to stay elevated, it signals that the institutions themselves no longer trust the paper supply to meet their physical obligations. In the world of high-stakes commodities, lease rates are the smoke. A full-blown physical squeeze is the fire. To understand why the paper market is losing its grip, we must transition from the digital ledger to the factory floor. This is where the concept of industrial inelasticity transforms from an economic theory into a systemic crisis. At the heart of this shift is a fundamental change in how the world generates power, the rapid global transition to TOPCon solar technology. For years, the silver market operated under the assumption that industrial demand was flexible, that if prices rose too high, manufacturers would simply thrift or find substitutes. However, the move to TOPCon, tunnel oxide passivated contact, cells has shattered that assumption. According to the World Silver Survey 2024, the photovoltaic sector is no longer just a participant in the silver market. It has become the apex predator of physical supply. The technical reality is uncompromising. Industry reports indicate that TOPCon cells require significantly higher silver loading than the older PERC technology they are replacing. Analysts suggest that TOPCon cells use roughly 30% to 50% more silver paste per watt to achieve their higher efficiency ratings. While a financial speculator might be deterred by a 20% price spike, a manufacturer with a multi-billion-dollar gigafactory and standing delivery contracts for power grids cannot simply stop production. They are inelastic. They are price takers who must secure the physical metal to maintain operations, regardless of the spot price dictated by paper contracts in London or New York. As of late 2024, the scale of this demand is difficult to overstate. Looking at the Q3 2024 industrial demand forecasts, global solar installations for 2024 and 2025 are projected to continue their vertical trajectory. This creates a structural vacuum that is effectively emptying the world TEM's vaults. In a traditional market, a price rally would trigger a drop in demand. But in the current environment, the silver required for the green energy transition is a non-negotiable chemical requirement. You cannot build a TOPCon cell with a cash settlement or a digital derivative. You need the atoms. This is where the paper market warrant TM's ability to suppress prices hits a physical wall. Historically, bullion banks could manage price volatility by increasing the paper multiplier, MOS, issuing more digital claims to silver to satisfy buyer interest. But a solar manufacturer in Jiangsu or Arizona doesn't want a claim. They want delivery. As reported in recent industrial surveys, the volume of silver being diverted directly from mines to industrial consumers is leaving a dwindling surplus for the investment and banking sectors. Analysts suggest we are approaching a zero-sum reality. If the solar industry's appetite continues to grow at its current pace, it could theoretically consume nearly the entire annual global mining output within the next decade. At the time of this recording, the gap between annual production and total demand is being filled by drawing down existing warehouse inventories. But those inventories are finite. When the registered stocks on the exchanges hit a critical floor, the paper market loses its leverage. The industrial inelasticity of the solar sector ensures that there is a permanent rising floor under the silver price, a floor that is built on industrial necessity rather than speculative sentiment. In this new paradigm, the paper price is increasingly seen as a fiction, while the physical price are driven by the desperate requirements of the world TM's energy infrastructure, becomes the only reality that matters. The TOPCon factor isn't just a trend, it is the mechanical force that is breaking the back of the silver manipulation narrative. At the heart of the global silver market lies a hidden volatility trap governed not by human greed, but by institutional risk algorithms. This is the margin sensitivity paradox. To understand it, we must look at the risk managers within the major bullion banks who oversee the larger paper multiplier, or who respects the staggering ratio of digital silver contracts to actual physical metal. Based on exchange data as of late 2024, the total notional open interest in silver continues to dwarf the physical registered inventory held in COMEX warehouses. When volatility spikes, the risk models at these banks face a mathematical crisis. Bullion banks typically hold massive short positions to hedge their physical operations. If the silver price rises rapidly, these banks face mark-to-market losses, triggering internal mandates to reduce exposure immediately. This is where the paradox becomes a trap. To protect the institution of TM's balance sheet, risk managers must buy back silver futures to close out their shorts. This defensive buying creates even more upward price pressure, which in turn triggers further margin calls for other participants. Analysts suggest this creates a forced buyer feedback loop. In this scenario, the smart money is now called TMIT, buying because they want to, they are buying because they have to. This mechanical desperation is compounded by what industry reports identify as a rehypothecation trap. Because a single physical bar may have multiple digital claims against it, a sudden rush for physical delivery can cause the paper market to disconnect entirely from the physical reality. Historical data from the 2011 peak and the 2020 liquidity crisis shows that when the paper to silver ratio is stretched too thin, the delivery mechanism begins to seize. Looking at the trailing 30-day average of COMEX registered stocks, the buffer required to settle these paper obligations is evaporating. Unlike retail investors who can choose to hold or sell, an institutional risk manager facing a margin call is a price-insensitive participant. They are legally and contractually obligated to liquidate. At the time of this recording, the extreme concentration of short positions among a handful of banks suggests that the silver market is one volatility spike away from a defensive chain reaction. We are no longer talking about a standard price rally. We are describing a systemic margin call where the very entities designed to provide liquidity become the primary drivers of a vertical price explosion. The plumbing is not just leaking, it is under so much pressure that the next surge could shatter the pipes entirely. As of late 2024, the New Silver Playbook has shifted from speculative prediction to a sophisticated monitoring of exchange integrity. For those analyzing the market by TM's structural health, the focus is now on an institutional checklist. 3 specific metrics that signal when the system TM's plumbing is reaching a terminal state. The first indicator is the anomaly in silver lease rates. Historically, these rates remain near zero, reflecting a surplus of available metal. However, when 1-month and 6-month lease rates spike or remain persistently elevated, industry reports indicate a hidden liquidity crisis. Analysts suggest this is a primary signal that the unavailable supply in London and New York is being hoarded, indicating that the digital ledger is losing its connection to physical reality. Second, risk managers are prioritizing the ratio of COMEX registered inventory to total open interest. Looking at the trailing 30-day average, experts are watching for inventory inertia. If prices rise, but physical stocks do not migrate into the registered category to satisfy delivery, it implies that current holders no longer trust the paper price as a fair exchange for their metal. Finally, the ultimate metric is the divergence between the spot price and the actual physical acquisition cost. In a systemic failure, the paper price might move lower during a broader market margin liquidation, even as the premium to secure physical bars moves to record highs. This analysis is not a call to action, but an educational framework for recognizing mechanical failure. At the time of this recording, the gap between notional paper claims and tangible supply is at a historical extreme. We are entering a paradigm where the nominal price becomes secondary to physical availability. By monitoring these specific points of failure, one isn't just watching a ticker, they are observing the structural limits of the modern financial architecture.